Dear students, now I am going to discuss about very important provisions of the Income Tax Act 1961, that is minimum alternative tax. In short, we call it MAT provision, which is dealt in section 115 JB. Now, why the MAT has been introduced? The lecture will include the background of the introduction of the MAT provisions, that is MAT provision, and its functionality. We know we have two acts like Income Tax Act 1961 and the Companies Act, the recently introduced Companies Act 2013. The companies pay income tax as computed as per Income Tax Act, that is the taxable income which is computed as per provisions of the Income Tax Act, that is one set of accounts which is maintained by the company, and another set of accounts is maintained as per provisions of the Companies Act. So, the companies have two set of accounts. As per Companies Act, the company follows the revised schedule 6 to prepare the profit and loss account and the balance sheet. You know, the profit and loss account shows the profit, that is the book profit, and on the basis of this book profit, rather we should say the net profit, the company pays dividend to its shareholders. It's fine. But whenever the company pays the income tax, it declares that it has no sufficient profit or the minimum profit in respect of which the no tax is payable to the government. So, there is a difference between the book profit and the income, total income which is computed as per Income Tax Act for the purpose of the calculation of tax liability. So, when the company prepare the profit and loss account as per Companies Act, it can show the handsome profit which is distributed to the shareholders. So, shareholders are very happy to get a handsome amount of dividend. But at the time of payment of tax, the company is declaring that it has no sufficient profit. Why it is happened? As per Income Tax Act, the companies can avail various tax concessions, tax incentives, by which the taxable amount can be minimized. So, by availing various provisions, various allowances, various deductions, the company can minimize its tax liability, rather the taxable amount. The companies which does not pay the tax by showing the maximum incentives is called the zero tax companies, quote unquote the zero tax companies. So, here you would know the concept of zero tax companies. By taking the advantage of the tax incentives, tax concessions, tax deductions, the companies can minimize their tax liability, even they can avoid the tax liability. That is why it is called the zero tax companies. To stop this practice, the government tried to bring these companies under the tax net, because when they are paying dividend to its shareholders, the shareholders are getting the huge amount of money towards the dividend. But when government is claiming the tax, or at the time of payment of tax, the companies are declaring that they do not have the sufficient profit or income. So, bring such companies into the under the tax net, the company, the government introduced certain provisions in the Income Tax Act. The attempt was started by the Finance Act 1983, where in the Finance Act section 80 VVA was introduced. As per section 80 VVA, the companies are liable to pay a minimum tax, and it was started in the assessment year 1984-85, and it was effective up to 86-87. And according to section 80 VVA, a ceiling was fixed in respect of the total available amount of tax concessions or tax incentives for a particular assessment year. However, the unabsorbed incentives was allowed to be carried forward and was allowed to be set up in the subsequent year against the profit. But in 1987, the Act was amended. A separate section 115J was introduced, and for the first time the concept of book profit came into figure. And as per section 115J, the companies are liable to pay tax on 30% of book profit, and it was effective from the assessment year 1988-89 and 89-90. Again, the tax provisions were amended. From 1997-98 assessment year, section 115JA was introduced, and according to section 115JA, we have to compute two figures: the total income and the 30% of the book profit. If the total income is less than the 30% of book profit, then the amount chargeable to tax would be considered as 30% of book profit. That is, the company is liable to pay tax on 30% of book profit if it is more than the total income. This section, that is 115JA, was effective from the assessment year 1997-98 to 2000-2001. But from 2001 to assessment year, the Income Tax Act was again amended and section 115JB was introduced. As per section 115JB, the tax calculation has been changed. As per section 115JB, we have to calculate the normal tax as per Normal Tax Act and the tax as per MAT provision as per section 115JB. Now, we have to compare the tax liability as per normal provision and tax liability as per MAT provision. Now, the question is, what is book profit? In section 115JA, for the first time the concept of book profit was introduced. Now, we are using the concept of book profit. What is book profit? We have the profit and loss account as per profit and loss account, which is computed as per Companies Act. But as per section 115 JB subsection 2, we have to calculate the book profit. So, to calculate the book profit, we have to start from the profit and loss account as per profit and loss account. The profit and loss balance is the starting point. Then you have to add certain items and deduct certain items. For example, income tax paid or payable, amount credited to any reserve, amount of depreciation, provision for meeting uncertain liabilities, provision for losses of subsidiary companies, dividend paid or pay provided, expenditure relating to any income which is exempt under section 10, 10A, 10B, 11, 12 of the Income Tax Act. So, all these items to be added to the profit as per profit and loss account. And we have to deduct certain items also. Amount like amount withdrawn from the reserve or provisions, depreciation, amount exempt under section 10A, 10B, 11 or 12 of the Income Tax Act, and the amount of loss through brought forward or unabsorbed depreciation, whichever is less as per books of accounts. So, this is the book profit. So, you get the book profit. Now, how do you calculate the tax liability? We have two sets. Number one is the tax liability as per normal provision, and number two tax liability as per MAT provision. So, apply the tax rate in both cases. Currently, the MAT rate is 18.5% and for normal tax rate is the 30%. So, after calculating the tax, as the case may be, in case of normal provision it is 30% and in case of MAT provision it is 18.5%. You have to add the surcharge at the rate of 5% and then educational cess 2 and 1, that is 3%, secondary education and higher education cess. And in case of tax liability under normal provision, you have to deduct the tax rebate under section 89, 90, 90A and 91. So, you will get the tax liability under normal provision. Under MAT provision, again you have to apply the tax rate, that is MAT tax rate, that is 18.5%, then you have to add the surcharge at the rate of 5% and then educational cess at the rate of 2% and 1%. Then you will get the tax liability as per MAT provision. Now, you have to compare the two amount, tax liability under normal provision and tax liability under MAT provision. As per section 115 JB, the company is liable to pay tax whichever is higher. That is, if the tax liability under MAT is higher, it will be paid as tax liability for that year. If the tax liability under normal provision is higher, then the normal tax liability will be paid. It is okay. So, there is a comparison between the tax liability under normal provision and tax liability under MAT provision. If the tax liability under MAT provision is higher, the company is bound to pay the higher tax as per provision of section 115 JB. Here, the income tax authority has inserted another section called the tax MAT credit under section 115 JAA. How it works? As per section 115 JAA, the companies will get a benefit of tax credit. What will be the quantum of the tax credit? that is the difference between the tax liability under MAT provision and the tax liability under normal provision. The difference, this difference will be carried forward till 10th assessment year, and it can be set off against the next year's succeeding year's profit or taxable amount. So, this is the provision of 115JAA. The companies will get benefit of such tax credit till the expiry of 10th year, 10th assessment year, commencing from the year in which the normal tax to be paid. That is, in which year the normal tax is higher than the MAT liability, then the company may get the tax credit and is to be written off against such tax payable. So, this is the provision of section 115JB. Now, if we consider the whole thing, so ultimate objective of 115JB is to stop the practice of the companies which are intentionally trying to minimize their tax liability. This is the essence of the company of the section 115JB. Okay. So, there are two sets of accounts, there may be two sets of accounts, 150 Income Tax Act and the Companies Act, but the accounting policies, the depreciation method, the rate of depreciation, the accounting standard would be the same in both the account system. If they differ, the assessing officer has the power to recalculate the net profit. But ultimate objective of this section of this minimum alternate tax is to bring the companies, the zero tax companies under the tax net. So, this is all about today for the lecture. Thank you.